Hello, it's Eric Bushell with an update on the Signature Global Income and Growth Fund. The first quarter of 2020 started off strongly with new highs made in credit markets and equities. In March, though, the dual shocks of the oil price crash and the coronavirus lockdowns triggered a credit market freeze up in short-term paper and then ultimately right through the credit markets, and a domino effect into the equity market where there was a flash crash, which is consistent with a frantic deleveraging episode. Now, this shock was met with a vigorous response by the Fed and the Treasury. The Fed cut rates to zero and provided liquidity to the market, and the Treasury provided bridge funding in the form of deferred givable loans and extended unemployment insurance to consumers and businesses to carry them through the lockdown period. In response to this, markets staged a sharp recovery and the panic largely subsided. What worked and what didn't work in the first quarter? Well, what worked clearly with the Fed cuts was that rates fell sharply and our U.S. Treasury position performed strongly. Our underweight in high yield credit also helped as stresses were pretty profound in the high yield market. Golds performed as interest rates fell and T-bills were seen as a less interesting exposure in relation to gold, and the interest rate differential was narrowed. Equity sectors, including healthcare, where we have a big overweight, and staples as well, performed very well, in part because of the durability of their dividends, that they were cheap going in to the crisis, but also that Bernie Sanders dropping out of the Democratic race results in a more centrist positioning there and takes down the healthcare policy risk for the drug companies. On what didn't work, well, our real estate exposures took big hits on account of concern over the solvency of retailers. The materials stocks, whether that was in packaging or in base metals, suffered with the big downward revisions of economic activity. Energy and banking sectors also both fell sharply on concern of unemployment and less transport activity, taking down commodity prices, but also resulting in banks struggling with more non-performing assets in their unsecured consumer credit portfolios. And so looking forward, really things are going to boil down to the duration of the lockdowns and how we progress in combating the virus.